Do you remember these two portfolios from my first video, balanced and high growth? For anyone just joining us in this video, you will see that they essentially invest into the same things. It's just the weightings of different asset classes like shares, cash, fixed interest that differ, and then percentage of growth in defensive assets. We looked at the returns, and going even further, you will see on this table the last 15-year average return per year on the column to the right. You will see high growth and balance at 9.69% and 8.75%. I want to draw your attention to Australian shares and international shares, cash and fixed interest, and you will see that shares is the things that actually bring higher return, and cash and fixed interest actually bring the portfolio return down. We will take the return of balanced and high growth, and then the expected return of the mixed portfolio per annum is 10.2%, which is a mix of high growth Australian shares and international shares. Now let's create a hypothetical scenario. We'll call this person Jane. Retirement age where you can access super 60. The current age is 32, 28 years till retirement, with a current superannuation balance of $80,000 and contributions of $250 per week. We are going to go on to a compound return calculator or interest calculator. I'll put that in the description below of the one I use. And we're going to use the details from our hypothetical scenario to see what the balanced portfolio can do. Number one, $80,000 initial investment, current super balance. Number two, 8.75% balanced portfolio return over a 15-year period per annum. Number three, at 28 years till 60. Number four, deposits. Number five, $1,000 monthly, which is $250 weekly. Number six, and number seven, 0% increase, and compound frequency yearly, and that is conservative. And you will see the final value is going to be 2,188,818 at the age of 60, assuming everything stays constant. Now we're going to compare this with the high growth portfolio, and we're just going to change number two. As you can see, changing number two, which was a return rate 9.69%, our portfolio went from the 2,188,818 2 million to 2,660,166. Just doing this little change, if we go into our calculator, the high growth return of 2,660,166 minus balance 2,188,818, which has a difference of $471,348. And you will see in our next video the importance of the final value, which is what I'm going to show you. The mixed portfolio, which I will put here, it aims to do a 10.2% return, number two, and the final value can be 2,959,296. So as you can see, the returns, especially for a long period of time, make a huge difference. What you need to do is look at your current portfolio, what are you invested into, your current age, your current super balance, contributions per week, and on the compound interest return calculator, see what you can achieve by making these little changes.
So in the previous video, we looked at the different portfolios and their returns, what they invested into, like asset classes, and you would see that mostly invest into the same things. It's just the percentages invested into the asset classes change, like shares, cash, and bond, to more growth and more defensive assets. You saw that if you have less time to retirement, you would go for more conservative and defensive approach. If you had a lot longer till time to retirement, we'll go for a more growth focused approach. In this video, we looked at, depending on the different investments, the small changes in the portfolio, the outcome can be quite large. That's what we saw in this video. And in the next video, what we're going to see is how we create a plan and how much we need to invest for ourselves, depending on our own circumstances, and to have a comfortable retirement. So I hope you have found this video helpful. Please don't forget to like, comment, and subscribe, and we will see you in our upcoming videos.